Now let's turn to Windhoek Mines Ltd. For this problem, we have been asked to calculate the NPV and IRR for the purchase of equipment. The process is the same as our first analysis of Basta Corporation. We need to calculate the initial investment, determine the years covered by the project, understand the amount, types, and timing of cash flows, and discount all cash flows using the minimum acceptable rate of return. For the equipment purchase, the initial investment totals $375,000, which includes the $275,000 cost of the equipment, plus the need for $100,000 of working capital. The expected life for this project is 4 years. There are 3 types of cash flows for this project. The initial investment of $375,000 is a cash outflow in year 0, which is the day 1 of the project. Because the investment is a cash outflow, it's entered as a negative. The annual net cash receipts total $120,000 and represent the increased sales revenue minus the expenses paid for salaries, utilities, insurance, and other expenses. The $120,000 each year is a cash inflow. During year 3, there is an additional cash outflow of $40,000 for new road construction, resulting in a total cash inflow of $80,000 for year 3. Both the salvage value and the release of working capital are treated as cash inflow amounts during year 4, resulting in a total cash inflow of $285,000 at year end. The minimum required rate of return is 20%. Because the rate is used to discount all future cash flows, it is the discount rate. The cash flows for this purchase are uneven. Since cash flows are uneven, it's best to prepare a cash flow schedule and determine the present value of each year's cash flows separately. Once the present values are determined, sum each year to calculate the total. Subtract the present value of the net cash flows from the initial investment to get the NPV. Because the initial investment takes place in time 0, the $375,000 is the present value of the investment. Now let's use the financial calculator to calculate the remaining present values of cash flows. For year 1, enter 1 for N, 20 for IY, 0 for PMT or payment, $120,000 for FV. Press the CPT button, press PV, and the display will read $100,000. $100,000 is the present value of $120,000 to be received 1 year from now, discounted at 20%. For year 2, enter 2 for N, 20 for IY, 0 for PMT, $120,000 for FV. Again, press the CPT button, press PV, and the display will read $83,333. For year 3, enter 3 for N, 20 for IY, 0 for PMT, $80,000 for future value or FV. Press CPT, press PV, and you'll get $46,333. $296. For year 4, enter 4 for N, 20 for IY, 0 for PMT, 285,000 for FV. Press the CPT button, press PV, and the display will read 137,442. The total for the PVs for each year is $367,072. Subtracting the initial investment will produce an NPV which is negative of $7,928 rounded. You would reject this project. While this approach is acceptable, it does not lend itself to an IRR calculation. An easier way is to use the CF function on your financial calculator. The CF button is located on row 2 of your calculator. You'll also notice that there's a button for NPV and a button for IRR. The CF, the NPV, and the IRR button will all be used to calculate the NPV and the IRR for uneven cash flows. To start the problem, click on the CF button. CFO will appear on your display. If there is an amount displayed, press the second button and the Clear Work button at the bottom of your calculator. CFO will now read 0. Enter 375,000 as a negative and press enter. CFO stands for cash flow in time 0. When entering amounts in the CFO for an NPV calculation, you'll enter them as a negative because they represent a cash outflow. Next, move over to the arrow down button and press it and enter 120,000 for CO1. CO1 stands for cash for period 1. Arrow down again and enter 2 on the FO1 screen and press enter. F stands for frequency. Since 120,000 repeats itself for 2 consecutive periods, you will type a 2. Arrow down and enter 80,000 in CO2. Arrow down and enter 1 for FO2. Arrow down and enter 285,000 for CO3. Arrow down and enter 1 for FO3. At this point, you have entered all the cash flows. Press the NPV button. The display will ask for the I. Enter 20 as a whole number. Arrow down, and the display will read NPV equals 0. Press CPT, and the calculator will display a negative 7,928.240741, which rounds to a negative 7,928. This project will be rejected. Since the NPV is negative, the rate of return for this project must be less than the 20% minimum required return. To prove this, we will determine the project's internal rate of return. Simply press the IRR button on the calculator. Then press CPT. The display will read IRR equals 19.02110693. The IRR for this purchase would be 19.02%, which is less than the minimum required of 20%. Finally, let's do the same problem with Excel. To present value the cash flows for year 1 through year 4, use the formula that's shown here. Since time zero is today, the $375,000 is the present value of the initial investment, and it's entered in as a negative. Place your cursor in year 1 and point and click for each of the variables needed. Make sure you anchor the column for the rate, and make sure you enter the FV as a negative. The PV for year 1 will be $100,000. Now copy your formula across and hit enter. The present value should be identical to the results using the financial calculator. The NPV can now be determined by summing time periods 0 through 4. The total will be a negative $7,928 rounded, just as the previous calculation. To determine the IRR, use the formula provided. Type equals IRR in a bracket, shade the actual cash flows, not the present value cash flows, but the actual cash flows, close with a bracket, and press enter. Your IRR will again be 19.02%. Just like you did before. We have completed 2 problems using the calculator in 3 different ways. For problems with annuity payments and lump sum amounts during the final period, we were able to use row 3 of the TI Business Analyst 2 calculator for all calculations. For problems with uneven cash flows requiring an NPV calculation, we developed a cash flow schedule and present valued the future cash flows for each year using row 3 of our calculators. For problems with uneven cash flows requiring an NPV and an IRR analysis, we needed to use the CF function on the calculator. We also demonstrated how to solve the second problem using Excel. You should be able to see why Excel is the tool of choice today. Excel delivers both speed and accuracy. Just as Excel is the tool of choice for calculations, NPV and IRR are the metrics of choice for analyzing capital expenditures. I hope seeing these videos demonstrate the value of each. Good luck.